And that, of course, takes us to our talk of the tape, and it is this record rally and whether or not it's here to stay. Let's ask our panel. Trivariate Research's Adam Parker, Capital Area Planning's Malcolm Ethridge, and Citi's Scott Kroner are all here today. Adam and Malcolm are CNBC contributors. Adam, let's start with you because you are here on set with me today. Quite a rally today. Large cap tech leading the way, momentum back in focus. Not so much in the way of breadth. It's kind of evenly split today. What do you make of the moves?
Well, when I talk to institutional investors, I feel like one of the things that hurts most of them is if these grade 8 stocks, the Mag 7 plus Broadcom, outperform, right? Either because they have 525 rules or risk management that was built before stocks got this big, they're just sort of structurally underweight. And so, if you take that view of sometimes, maybe it's a cynical view, but sometimes what unfolds actually hurts the most people, in active management. I'm not surprised to see the grade 8 outperform. I think they're growing faster. Their gross profits are growing faster. And I think a lot of people, preferred if they lag.
But you upgraded tech recently to outperform.
Yeah, we just think the absolute growth rate's so high. Sure, Micron and NVIDIA are driving a massive percentage of it. But, tech's supposed to grow 43% this year, 26, another 25% in 27. Even those numbers are way too high. Let's say they're 30 and 15 or something. If the tech stocks don't go up in absolute terms, particularly some of the fast growers, the sector is going to be 30, 40% cheaper in a year. That just seems very unlikely. So I think you've got to own semis still. That's been our North Star for a long time, semis over software. I'm probably more of a fader of the software rally that we're getting. I think that makes a lot less sense to me.
But this inflection, you just recently made that change. What was it, Monday?
Yeah, we were recommending market weight in tech with a preference of semis over software for the first kind of 3.5 months of the year. And I think, with some of the, just absolute growth rate still looking pretty solid, I thought it was time to get a little more aggressive.
Scott, I want to ask you because, we've seen kind of this return to the AI trade recently. How would you characterize that? Do you feel like it has more legs?
Yeah, we think it has a lot of legs from here. And the way we would characterize it is a little bit different than the way Adam described it. We've been on board with semis for, well over a year now. And going into this year, we've been underweight software, but we have to acknowledge that with software, you've had a pretty stiff valuation reset that we think has been pressure on terminal multiples, but you still allow from a lower valuation starting point these companies to demonstrate that they do have an AI playbook in many cases at hand. And then with hardware, you're led with Apple, but there too you're getting this picks and shovels play. So the way we're talking about it is that we've got semis as your tech leadership, software poised for, let's call it, a bit of a valuation rebound. And then with the hyperscalers in general, we think that the AI playbook is unfolding here where there's increased visibility on longer-term growth drivers that should come back and support the return on investment case there.
And Malcolm, it feels like this is actually happening alongside software, whereas, for a while now it's been kind of zero-sum game. Do you expect that to continue, or do you feel like 8 straight days of gains and the IGV is getting a bit stretched and, making some investors nervous at these levels?
Yeah, so interestingly enough, that is the feedback we're now getting from clients, which is you've been bullish on software through this whole sell-off that started back in October. We're now seeing just a week, I think, where the IGV, for example, is up more, or for the month, it's up more than 10%. And we're looking and saying, have we gone far enough? Is it maybe I missed the trade? And I'm looking at this and saying this 2026 has finally become the stock pickers market that we've been promising to clients and market participants for years now. We're finally in it. And I think it's a mistake to look at just the broader indexes and say everything has moved up too fast. The Mag 7 has moved up too fast. And so I shouldn't participate now. I think really there are still bargains and opportunities buried underneath the surface that investors should still be looking to take advantage of.
Okay, I want to talk more about that. Everyone stay with me as we're talking about, you've got the software trade higher again today. Seema Modi is here with more. Seema.
Well, Leslie, as you just pointed out, the 8th straight day of gains for the IGV is pretty significant, and it comes as we await for ServiceNow earnings. The SaaS company will need to prove that its AI monetization strategy is gaining traction from enterprise clients, as both OpenAI and Anthropic have been increasingly going after that customer. One vote of confidence for the sector is buybacks. Adobe out with a $25 billion buyback last night. That represents a quarter of the company's market cap, and it does follow similar announcements from Salesforce and Intuit, although some analysts have been pushing back on whether software companies should be allocating more capital towards research and development, given the broader AI displacement fears. Although one company trouncing those fears is Twilio. Bank of America out with a double upgrade. Analysts there believe this company is playing a key role in the AI-driven voice and messaging space. Would also point to Palantir securing a $300 million contract with the U.S. Agriculture Department to modernize farmland. That's one of the biggest movers, Leslie, today in software, up 4%.
Yeah, it's certainly an idiosyncratic market there. Seema, thanks so much. Adam, you were kind of nodding your head over here.
Well, I think about like the tech bubble when it imploded March 2000 to October 2002. The NASDAQ goes down 77%. Even during that 77% decline, there were still 10 rallies of 15% or more, right? I can't help but thinking that the software rally is just like that. Like, we are not done. There isn't an all clear moment. I think it's actually the opposite, which is, a lot of these business models are going to be impaired. The probability software outperformance on a multi-year view is low, in my opinion, as an industry, the equal weight one. There will be some winners, there will be dispersion. So I'm not saying, I agree with Malcolm's point, there should be a good opportunity for stock selection. But I think what's clear is whenever multiples contract like this, what ultimately happens is they miss on earnings. And why do I think that's going to happen 12, 18 months from now? It may not be tonight with now, but the reason is because the analyst estimates embed the same gross margin and the same net margin going forward for every business.
Right.
Somehow they're supposed to attach all these AI tools that prevent them from ever getting fired by their customers without any OpEx or CapEx. Moreover, somehow they're supposed to keep the same pricing power even though their vendors know what their margins are. I think that's an incredibly unlikely equation in a couple years. So I think what's going on is the analysts do what they always do. They call the CTOs of the customers. They say it's fine, we're not firing them. They call the IR guy. They cry in each other's beer. But the market's trading more on fundamentals than people think. It's not some sort of, oh, this is illogical, it's second derivative Hormuz. No, it's trading on a distribution of outcomes for 2030, and that distribution of outcomes got structurally skewed to the negative. So I feel like I'm seeing the ball clearly, which sure, if you're good enough to trade 7 or 8 out of these 10 rallies that happen on the downtrend for the next 3 to 5 years, God bless America. I'm not good enough to do that, so I'm going to stay structurally more cautious when I know what's coming, which is earnings miss and then sales miss. It's just going to be 1, 2, and 3 or 4 years in the future. It's not going to be necessarily this week. Well, semis are different. They're much harder to replace, and so that's the North Star, semis over software.
One of the data points on the software side, I see on the tape Reuters reporting that Thoma Bravo is close to an agreement in transferring ownership of Medallia to its lenders. This has been a pretty troubled software name for Thoma Bravo. And according to a person familiar with the matter, Reuters is saying that will result in $5.1 billion in equity losses for Thoma Bravo. And you've got a bunch of these asset managers that own the debt there. So Malcolm, maybe we turn it back to you just to talk about just the dispersion of outcomes among these software names and how investors can really assess which ones have moats, which ones are able to transition in the AI era, and which ones are going to see a fate similar to that of Medallia here.
Yeah, I think Adam was making a great point in the sense that if we're looking just at the whole, we shouldn't be looking at software as something that this trend, this rebound that we're seeing is going to stay this strong for the next 1 year, 2 year, 3 year periods, just because it doesn't really make sense that it would, because we don't have all the data yet to know who's going to truly be disrupted by AI, who's going to be enhanced by AI, and who's just going to kind of middle along the way for the next 3 to 5 years. But I do think when you look at a company like ServiceNow, you mentioned as an example, it is more likely than not that ServiceNow will make it out of this period that we're in. There are a lot of companies that are going to have to change the way that they bill their clients, their customers. They can't just be on a per seat basis anymore. It's going to have to be based on consumption. And so the faster companies can get to that model, the faster they can get out of this valley of death they've been in. And so I think that it's really important that investors have a little bit of patience if they do want to play in this space. I think that it's also important that they don't necessarily try and just buy the index as their way to get exposure, thinking that buying the dip the way that it has on like the NASDAQ, for example, has worked out for the last 5 or 6 years.
Right. And Scott, as they change their business model, I can't help but think and wonder whether that kind of going from a per seat model to a usage based model where it's based on time and consumption, whether that would be deflationary, whether what you're seeing with AI would be deflationary. I mean, how are you thinking about these various trends and the transitions in tech and what it means for the overall inflation picture?
Yes, I think it always comes down to time frames, and I think in terms of how you're thinking of your investment horizon and the choices you get within that. So no doubt within software, the SaaS companies are probably most at risk, but you're paying, in many cases, mid-teens PEs for these companies. You can turn around and go buy a cyber play for 40 to 60 times earnings. So again, this expectation for future longer-term growth becomes relevant, but then how do you trade them over a 1 quarter, 2 quarter time frame? How do I think about that in the context of our year-end S&P 500 price target? I need all the tech working to kind of get to our 7,700 level. So I think the setup in here is that you hit most of the software companies, particularly around the SaaS component earlier this year. These companies aren't going to sit still. They're going to come back and they're going to demonstrate how they're going to respond and how they can turn this into something. But to your initial point, no doubt in our mind that the longer term impact of AI probably does have a deflationary component to it. Software is going to be part of that. Corporates are going to have choices in how they spend their precious tech-related budgets on this. And I think that deflationary component is something that we have to keep an eye on, particularly as we weigh that against other measures in the market, whether it be energy and other inflationary metrics that the Fed needs to contend with.
Yeah, I mean, a couple of things. First of all, if you study, I'm pretty confident that if you're going to buy any individual software name, you want to buy one that's fast growing and is expensive. You don't want to buy cheap software, for sure. The data is really compelling on that. So the reason you don't want to is the ones that are cheap have just a higher probability of being disrupted and impaired. The market's not stupid. On average, it gets that right. So I think if you're going to dip your toe, you want to pay more money. You want to buy, security, or maybe it's Cadence or Synopsys or something that can grow faster. The market trades stocks at 35 times earnings for a reason relative to ones at 15 times. So I wouldn't use valuation for security selection at all in software. And then the other thing is, when you look at the index level, you always got to be careful. I don't know the components of the IGV, but in the S&P 500, Microsoft is a massive portion of the software performance. So I think it makes sense, the same way tech might look cheap because Micron is cheap on earnings and is growing much faster. So then your book looks different than Micron. So the devil's always in the details how you parse this stuff. But I'm pretty confident that of two things. One, the equal weight software underperforms over the medium to long term and probably meaningfully. And two, you want to buy fast growing, expensive ones, not cheap and slow growing ones.
Do you feel like there's any threat to whether it is software or some of the incumbent, not native AI companies, but companies, hyperscalers and so forth, that are in the market when we do start to see some of these mega IPOs come and hit the tape, SpaceX being among the first, reportedly in June?
Look, I'm getting that question a lot from investors, how do I think about the supply demand for it? As you know, not everyone's going to get an allocation, and a lot of people have risk rules, so they've got to be tight tracking to that. So I think there'll be a lot of buying power for that one, but I don't think it's a zero-sum game, meaning if I buy $10,000 worth of a $50 million market cap company in my PA, the company could be worth $70 million at the close. My $10,000 doesn't equal the $20 million, right? It's the same thing. It's not like it's a dollar for dollar demand story. So there'll be a lot of buying power if it's $75 billion or whatever they float for SpaceX. But it's not like Tesla has to come down the same market cap that SpaceX goes up. That math doesn't make sense. So I think people will buy it and buy a lot of it. But I think SpaceX is a little bit one of one, and it's a little bit different than Anthropic and OpenAI.
Yeah.